Xavier, thanks very much for joining us. Obviously a big focus there at Catella on particularly sustainability, drive for sustainability within the residential side, the elitist towers, those kinds of elements. I guess, what are you seeing at the moment?
Well, we think what the key point is to integrate climate change into your investment strategy. So not doing it as something that is peripheral, but really try to think about climate change is hitting us and how can I mitigate and adapt within my investment strategies as best as we can.
Everybody would say that is a good thing to do, but I guess the question then is actually how do you do that? What's the operational side? What do you do to try to achieve?
One of the things that we talked a little bit about last year, it's about getting the valuations right, and we did a lot of work on that. This year actually we're focusing a little bit more about the cost machine of decarbonization. So there's a kind of a logic that I think is not explained well enough and not incorporated well enough in the investment industry, which is that mitigating climate change, which has both a substitution effect on costs and has a multiplying effect on costs. And those two elements are key. So what is substitution? That's a God-given kind of present that we have, which we really should maximize, which is that if I have an old gas pump in our resi units and we exchange that for a heat pump, which is more environmentally friendly, and I do that at the end of the life cycle of the gas heating system, then actually there's a substitution effect. I would have needed to do something else anyway, right? So that timing moment limits my costs a lot. So that's a very cheap way of greening your assets. So we should really maximize that, because unfortunately in mitigation there's not only substitution minimizing cost effect, there's also a multiplication effect on the cost. So it's the other side of the balance basically, which is that if we don't mitigate enough, which means if we don't green our economies and take down the CO2 levels enough now, then the cost of adapting to climate change will be incremental. There are a couple of cost components. One is adaptation, the other one is damages, and the third one is ultimately getting the CO2 levels down, the parts per million of CO2 equivalents down to a normal level so that it just doesn't continue. Those three costs, they blow up if you don't mitigate on time. So the key to kind of solve or as best deal with this huge challenge we have is to focus on mitigation and integrating that into our investment strategies. And we are asking our investors to pressure us and other co-investment managers to basically decarbonize as much as possible as we can now, because they are the long-term holders of these assets. So if they don't kind of push us, and we are very happy to be pushed, to decarbonize now, the bill will only get bigger. And who will pay the bill? It's the owner of the asset. That's the long-term owner of the asset. So that's the pension fund. And behind that, well, guess what? That's you and I again, right? So it's a really silly thing to kick the can down the road. What we think what we should do as an industry is focus on the financing of it and find the cheapest finance strategy possible to decarb our assets and then do something good for the planet. And that means we need to focus much more on mitigating than what we've done.
And it's interesting to see what you say there about the role of institutional capital and the pension funds in creating that drive for the investment managers. Really interesting to catch up. Thanks, Xavier.
Thank you.